Hello everyone and welcome to Staying Ahead of the Curve. I'm Jeff Snyder, Vice President and Senior Consultant with Camac Retirement Group, and we're coming to you live from Washington, D.C. at the Defined Contribution Institutional Investment Association's Public Policy Forum, and I'm joined today by the President of Great West Investments, Mr. David Musto. Dave, thanks for joining us today.
Great to see you. Thanks, Jeff.
So before we get into your thoughts around investments, investment structures, et cetera, we're here at DCIA, and DCIA is a very prestigious organization. I wonder if you might take a few moments to kind of update the audience about your perspective about DCIA. You've been a long-term member, and you've seen it evolve and grow, so I wonder if you could share your insight.
Yeah, so I'm fortunate enough to have been around for 5 years now. I wasn't one of the founding members and the folks that deserve a great deal of credit for really bringing DCIA into being, but have been around long enough to really be able to observe and see the evolution of the organization. And I couldn't be more proud, and I think there's a lot of folks that are proud of the contributions that DCIA is making in the industry today. There are a few organizations that with the limited size, right, of staff have been able to produce as much as it relates to thought leadership and research and insight in the industry, obviously with a specific focus on institutional asset management, but I think a group that thinks much more broadly around best practices and ways to help participants and sponsors be more successful. So I think it's a great thing for the industry.
It's very collegial. I mean, you have representatives from all different facets of the industry. When you look at most industry groups, they represent usually a subset of people in the industry. This one is really taking that very broad approach, and it's very collaborative.
You bet, and it's not a lobbying organization, right? So, and you know, the leadership talks about this a lot. Is how do we do our best to be thoughtful, to drive research, drive insights, drive the conversations through events like this that ultimately manifest itself in better decisions and better direction in the marketplace.
And there are different subcommittees and committees and subcommittees that are all focused on different tactical or strategic areas.
You bet. And the wonderful thing about this organization is the membership. This is very much a membership-driven organization in terms of the work. And you don't see, many of the large industry trades are driven by professional staffers that are, working 9 to 5 and doing all their stuff. But this is a group of people that really care about making contributions, and they're willing to roll up their sleeves, get around tables, contribute, write, talk, and do all that great stuff.
A lot of good thought leadership. So let's shift gears a little bit. We had on Stacy Schaus previously talking about investment structure, and your organization manufactures, creates investments. And I wanted to get your perspective first on investment structure, but also then go in the direction about investment vehicles and things that you're thinking about in your laboratory, if you will, the next phase of investments for defined contribution plans.
Yeah, so I think it's a very interesting and dynamic period, and there's a lot of talk about vehicles, there's a lot of talk about active, passive, and topics that you speak about ad nauseum. But I think when you kind of rise above that at a higher level, you step back and you recognize that the industry is still grappling with how do you construct investment solutions that live harmoniously, right, with the delivery of retirement programs and are sensitive to the human behaviors of individuals, right, what they do well and what they don't do as well in terms of really preparing and being ready for a successful retirement. So the delivery mechanism needs to really be considered as we think about investment construction. And I'll give you one example. I think there's this tug of war that's happening increasingly within DC plan lineups. For all the right reasons, sponsors, guided by advisors and consultants and providers, are trying to simplify core lineups, right? Because we don't want participants to blow themselves up. On the other hand, we're entering the day of professionally managed solutions and hybrid solutions where we can tailor and customize asset allocation specific to an individual. But if we have a professional manager that's drawing from a set of individual core funds that aren't robust and may not include certain asset classes and strategies that would contribute to better volatility control, better diversification, are we really serving the participant well? And that's not an easy one to crack, right? But you're seeing a lot of creativity amongst providers, amongst participants in the marketplace trying to get to the right place.
In terms of the diversification of asset classes, can you kind of go into a little bit more detail about we've always talked about tips and the traditional equities, but what you and your team are really thinking about in terms of some of these alternative strategies you put, not necessarily alternative, but alternative strategies to put into an asset allocation.
Sure. Yeah, and to be clear, we don't have a dog in this fight. We're not here saying real estate's the thing or tips or commodities. But just to orient you to Great West Investments business, we're a big provider of general account stable value capabilities. We have a sub-advised mutual fund complex across asset classes, strategies, target date funds, et cetera. Very focused on retirement income products. And we also manage in-plan managed account assets, right? So, as we sort of look across that spectrum of capabilities and how they fit in a plan, where, you ask sort of what, where's the innovation and what are you really thinking about? It's how do we better construct the solutions that are going to guide people to being able to better replace their income in retirement? I think the industry's done a great job with younger workers, right? If you just think about what's happened, right, in terms of auto default, enrollment, escalation, financial wellness programs, young people are saving earlier, they're saving more, and on a much better track. The issue is, and their biggest risk, of course, is not saving enough early in their careers. The big risk is for the mid and late stage workers, right, that maybe still have an opportunity to catch up a bit, but that day's gone in terms of starting to save earlier or more earlier in their career. Really, their focus needs to be, how do I create a portfolio that's going to be more in sync with what are divergent needs, objectives, risk tolerances of people at later stages in their lives. And that's where, we're big advocates of target date funds. Target date funds are, biggest QDIA option right now in plans. But if you look at how those funds diverge, right, in the later years for people that are approaching retirement, you could have one fund that has 30% equity and another one that has 70% equity, even though it's a well-diversified portfolio with all the right asset classes within it.
So when you're constructing, so let's go on target date funds for a couple minutes. When you're constructing an asset allocation and your folks are thinking about that, how important is participant information and that the plan ecosystems? Because every plan is unique. Every plan's got its own, I use the term ecosystem. They've got their own set of participants, age ranges, et cetera. When you're a manufacturer, when you're creating a product or products, how important do you take that?
Yeah, so it's very important. With a target date structure, though, you ultimately need to pick your shots. Yeah. So there are certain populations that may be primarily young and others that may be skewed older in terms of both the workforce as well as certain sponsors that are looking to maintain retired participants in the plan for longer periods of time. So you could be looking at two very divergent populations, and it's pretty hard to figure out an investment strategy that's going to serve both of them in the best way possible. So what you've seen is target date providers tend to gravitate toward a specific philosophy that they think is right for a specific type of population. And I actually think that's a good trend, right? And that's where, I think advisors and consultants are doing a great job in the market helping to match the demographics and the unique characteristics of a plan to the specific solutions that'll fit for them.
And so the other facet of this is you can build a great lineup, but communicating, educating, I mean, that's got to be in the back of your head too when you're creating these structures. So we're not just doing it in a vacuum. We're looking at the design of the plan. We're looking at the participants, and now we've got to figure out, even if we automate, how we communicate to people. Are we sending them fund fact sheets? Are we sending them a QDIA notice? But also, are they aware of where they need to be? And right. I know your organization has done a little bit of that type of work too.
Yeah, so a couple of thoughts there. One is research suggests about 30% of people may be misusing target date funds. Right, so they're combining target date funds with other investments or options in the plan. Now, the optimist would say, these are really smart people, right, that are into asset allocation, and they understand exactly. Less optimistic view would be, people are confused. Yep. And probably in the vast majority of situations, that's the case. So, number one, we need to remember that auto doesn't mean step away, right? In terms of engagement and communication with individuals, we need to help people use those solutions more effectively. The other piece, which I was sort of gravitating toward before, is as people are getting into these later stages and there's more benefit and value from having more tailored and customized asset allocation, wouldn't it be great if we could automatically default people further into a managed account solution or some other type of hybrid asset allocation solution that's more tailored to their needs? Because left to their own devices, while a significant percentage of plans are offering managed account solutions, adoption at a participant level, run on a proactive basis, is relatively low. So, is there an opportunity for us to guide people naturally on an opt-out basis to a better portfolio, but also a set of services, planning and advisory services that can help them make better decisions? When and how should I take Social Security? What should my decumulation strategy look like in terms of how much I can afford to spend on an annual basis and where I take that money from? Should the next dollar come from my IRA account, my Roth IRA, my after-tax account, my 401k account,
or my defined benefit plan, if you happen to be lucky enough to have that.
You bet.
So let's shift gears a little bit. We've got a rising rate environment. You're a product manufacturer of stable value and fixed accounts. Capital preservation is an important component within a defined contribution plan. What are you all thinking about in terms of stable value and fixed funds?
Yeah, so we're seeing a lot of interest in the conversation today, given where rates have been and where rates are headed. I think there's been much more focus and emphasis and much more question around money market relative to various flavors of stable value and general account capabilities. I think at the end of the day, having spent as much time as we do really focusing on those stable value types of alternatives, there are real benefits that aren't commonly understood by the marketplace. And the construct of those solutions allow for portfolio design and investment solutions that can capture and deliver higher rates of return with less volatility over longer periods of time, specifically for retirement investors. But it's also important for sponsors to think about how those capabilities are delivered. There are certainly different structures and vehicles in the marketplace: pooled funds, general account products, separate account capabilities.
And code sections, because 403B is different than 401k, than 457, than 401A. I mean, they're all so unique in terms of how you have to manage that particular pool, what the provisions are, especially in 403B.
Right, and I think one of the questions being asked now, we hear in the advisor and consulting community is, how do I do a better job of helping my clients make sense across this variety of options? The rates are different, the structures are different, the considerations in terms of contract provisions are different. So we're seeing a lot of focus and emphasis there. One of the things we want to be able to do, not only as a product manufacturer, but as a solutions provider, is help the marketplace think through those considerations. We're seeing the same thing, by the way. We were just talking about managed accounts before. That's it had not been traditionally, right, the focus and emphasis for advisors and consultants to roll up their sleeves and really be getting under the covers of those types of solutions, not only in terms of the investment management approach, but the whole delivery, participant engagement, communication strategies, et cetera.
Yeah, if you're a fiduciary following fiduciary best practices, you have a responsibility to peel back the onion on all the services that you're offering and how those things are working. David, let's shift gears. Kind of the last direction I want to go in is retirement income. And you do have a product that you've created, or products you've created, to help participants begin to draw down. So you talked about the millennial saving, and we've talked about auto features, the importance of putting money away early, auto-enrolling people and auto-escalating. But the drawdown, taking money out, is something that is really important. And I wonder if you could talk about some of the concepts you all are thinking about as you're designing products.
Right. So again, different classes of products that are out there today. Sort of a common form is the GMWB. We have a great solution there that we offer, but for us it's about, again, how's that implemented into portfolios, into a real, live, practical participant experience. One of the areas we've seen a lot of success with sponsors is the inclusion of those types of solutions in the managed account program. So, and maybe we're a little bit unique in terms of that offer and that structuring today, but what we're finding is that participants, again, left to their own devices, we know one of the major obstacles and hurdles to successful use of retirement income solutions in the DC plan environment is that participants don't fully understand, right, and don't engage as aggressively as they might benefit, right, from those actions. But if that is a natural progression, right, of a process guided into a managed account solution that's able to access those income guarantees and layer them in the right way relative to a person's distribution strategy, that can be really effective.
David, thank you so much for sharing your insight, and we look forward to having you back on the show, and enjoy the rest of the Public Policy Forum today.
Great, thanks so much.